So, Siddharth, I don't know if you've been reading the news, but the US just posted inflation numbers of 8.5%, which I think is insane because these are kind of inflation numbers that you expect to see in India. These are kind of inflation numbers that we were seeing in India about 10 years ago. Now, 8.5% inflation is obviously because of all the stuff that happened in the pandemic, where the US just poured in money to help the economy along so that it doesn't struggle during the pandemic. And now they're reaping the rewards now. Now, the question is, what is the impact of that inflation? The impact of the inflation is that the Federal Reserve, which is the central bank of the US, just like RBI in India, they are going to raise interest rates. And I believe they already have by half a percentage. Um, and the impact of that is that a lot of the money that was flowing out of the US, looking for other places to invest because money was so cheap in the US, now as money gets more expensive, some of that money is not going to be flowing out of the US as much. And a second order impact of that is going to be the amount of money that we see that is entering India for private equity, for venture capital, is going to reduce. And this is what people are calling the VC winter. And there have been VC winters in the past. 2008, I believe, was another one of those.
I
And
just
there
want to
will be.
double down. I just want to double down, Sahil. I just want to double down on why this happens, right? Why is the inflation increasing and hence the rates increasing and the VC sort of funding going down? I
Is
think
this going to be a Bitcoin plug? Is this going to be a plug for Bitcoin?
no, this has nothing to do with Bitcoin. A lot of the investors in these venture capital funds, the limited partners, so to say, are these institutional investors, these pension funds, university funds, right? When the interest rates are close to zero, they have no place but to deploy it in high risk assets so that they can make up those 8 to 10% that they need to make every single year, right? But as the interest rates start increasing, if you're going to get 2 3% on government bonds, you're going to put a decent amount of your portfolio there because you know that's safe and you're going to get the returns. So it's a very simple second order impact, but this is a cycle that, as you said, happens every single it happens every 5 7 10 years, keeps happening this cycle, right?
Yeah. Something happens, and eventually that leads to funds going in and out of the country. So, Siddharth, I've never worked in a venture backed company. What do you think is going to be the impact of this on VC companies, on the employees at VC companies? I mean, I've seen some news that big companies like Misho, which has like been the darling of VC for several years, they just laid off like 150, 300 people. I can't remember the exact number,
Yeah,
but
I,
yeah,
I
what's
don't
the
think
impact?
I think the miso sorry I think the miso news is hyped a little bit in terms of layoffs. They closed down a division that was just an experiment that did not work out, and they're closing down that division. I think the bigger news is in companies sort of shutting down and a large percentage of their sort of people being laid off. And the reason why this is happening is you have to understand what happened over the last 1.5 2 years, right? There was venture capital money that was competing with each other. So a lot of these venture capital funds were competing to get into companies. What that led to was people were getting higher valuations. People were getting valuations on without product market fit. People were getting investments without due diligences. People were just, because there was so much competition, right? Supply was high and the demand for capital was technically low, right? Or the other way around.
In the episode we just recorded with Sajid and just released last week, he said that the venture capital market in India is overventured.
Yeah.
There were some
For the
caveats to what he said, but it was
you should
overventured.
you,
Yeah.
you you should definitely listen to that episode if you're interested in the Indian startup ecosystem. I think that episode is one of the best episodes that we've recorded on the Indian startup ecosystem, so you should definitely go check out the episode that we did with Sajid. But you're absolutely right, we are overventured regardless given the market size. But over the last 1.5 2 years, it became obscene amount of capital, international funds, angel investors, everybody investing into startups. What that led to was, as I said, companies raised at too high a valuation, but companies raised at pre-product market fit. And people who caught a wave, right? They were at a point where something remote work or ed tech or things like that became hot. They rode that wave and raised capital. What that led to on the downstream impact was the salaries were increasing. There was a shortage of talent. People were going at 2x 3x the salary of their previous companies and stuff like that, right? This is what's happened in the 1.5 2 years. Now extrapolate that to with what the VC market today is. a lot of these companies, because they were pre-product market fit, a lot of these companies really hadn't figured out business model, right? A lot of these companies are not profitable at the unit economics level. So they need more capital to survive, right? Let's say you raise a 10, 15, 20 million dollar round. Now as a founder that you need to deploy this capital very fast, show growth, and therefore go raise the next round. If you were one of these people who burnt a lot of capital through customer acquisition, discounts, paybacks, cashbacks, whatever you call it, and you've burnt through a large amount of that capital, then you're left with very little in the bank. Your burn is very high, right? It's not like you can overnight just say that, hey, I'm just going to take off money from Facebook, Google, and I'm going to cut down on employees, because that sort of beats the entire narrative when you're going to go raise again, right? You can't have suddenly till June you were growing and then you were decreasing 20%, right? You can't explain that when you're trying to raise the next round, right?
Can I
So
can I
yeah,
sorry, can I plug another one of our episodes over here? The episode that we did with sorry, the episode that we did with Dr. John Mullins. That episode was all about how companies can become more capital efficient, right? And this is probably the lesson that a lot of these startups are learning now. They were in that whole burning money phase, and now they're going to have to figure out, hey, how do I get more capital efficient? And that's a
yeah,
tough switch to do.
yeah. I mean, if somebody could do this analysis on, the within venture capitalists, within investor startup ecosystem, however you call it, tech Twitter, right? The number of times words like growth and burn and fundraise were there, versus now there are words like profitability and unit economics and sustainability and all of those things. And this is a cycle, right? This is something that's happened previously in 2015-16. It's going to happen again. This is basically a cycle where there is a mean reversion, as people call it, right? Where a lot of funding has happened, and now to balance that out, this year is going to be slightly brutal. Maybe first half of next year is going to be slightly brutal, and then maybe we'll see the impact. We'll see the uptick again. But okay, let's think of it from a stakeholder perspective. What happens when the VC winter comes in? Let's Investors are the easy ones to sort of talk about. This is their game. This is how they play this game, right? They have a portfolio of bets. They've bet on a lot of companies. They've deployed a lot of capital over the last 1.5 2 years. The winners from there, they will keep doubling down on those, and I think they will make their returns. I was also looking at something somebody tweeted about. Even the venture capital funds, only a small percentage or less than 50% of those people actually beat the market, right? So even these VC funds that we talk about, there's a survivorship bias on a Sequoia being in the news, or a Lightspeed being in the news, or a Bloom being in the news, because they are truly the outliers and good brands who have figured out how to play this VC game. There are a bunch of others that probably came in the last 2 years who are not going to be able to give you the kind of returns that you want from a venture capitalist, right?
And angel investors too.
I mean, that's a topic for a discussion. I think I've made those mistakes over the last 2 years, and some people have done it with a lot more capital. I've done it with a very small capital. I was at least disciplined in that sense. But okay, so investors, this is their game. I don't think they're going to be impacted too much. Certain investors may not show those kind of returns, but the good ones, the branded ones, have played the game really well. They've deployed their capital across a large variety of startups, and then they will double down on the ones that start winning, right? Now let's look at it from a founder's perspective. And this is where it gets slightly tricky, right? Some founders are smart. Some founders are know that, hey, this is a narrative game and I need to sell this narrative to raise the next round and stuff like that, who've done this well over the last 1.5 2 years. And maybe they will not be able to justify the valuation and everything, but they will figure out how to cut down their burn, how to keep this capital safe, and how to just iterate and figure out product market fit. They will realize that, hey, maybe I will not win in the next 3 5 years. Maybe it's going to take me 7 10 years. But let's stay in the game right now by reducing my burn. Or some smartest founders probably wouldn't have increased the burn too much anyway, right? They would have kept the cash in the bank for a rainy day, and this is that rainy day. Those are the founders that will survive and win. Then there's a next category of founders who would have gotten a slightly overconfident, right? In the sense that, hey, because I was able to raise at this valuation and this tap is always going to be open, and therefore I will keep raising at a higher valuation moving forward, they're going to have a very tough time. Within that segment, some people would have taken secondary. Some people would have realized that, hey, this is a hot market, let me take a million or 2 million $3 million secondary. So financially they're going to be okay. Some founders would not have. They're going to suffer slightly more financially. The other aspect that I want to talk about, and this happened into the 2015-16 cycle, where a lot of hyper local companies were funded, and the VC downturn happened. A lot of these founders go through burnout, go through the mental health trouble, right? Because they've given it all for 2 3 years, because they raised, let's say, $5 7 million. It's not like you can give up on that company in 12 months. Even if you realize that this is not going anywhere, the winding down aspect of something, of a company that's raised from venture capitalists, is probably registered in the US and stuff like that, is a 2 3 year process that can definitely impact the mental health of some of these founders, and some of these people would have burnt out and stuff like that, right? But yeah, so these are the broad categories of founders. But hey, this is, they got into this game knowing the risks of this game, right? I think more often than not, more than, sorry, um, most of these founders will take this on the chin and try and move forward and try and build something and take this experience into account. A lot of these people are young folks, they'll get another opportunity. Second time founders are revered in the VC ecosystem, so I think they'll going to be more or less fine. In my experience, the biggest bag holders are generally the employees, right? These employees who joined at heavy ESOPs and, cash increase of 2x 3x, and ESOPs of, 40 51 crores. All of this is paper money. Now a lot of this paper money is going to just not exist, right? Because these founders, these companies will not be able to go raise the next round of capital. They will go through layoffs. So a lot of, smart people, but because they're expensive on the payroll, will have to be laid off. A lot of this churn is going to happen. What does an employee have to show for all of this, right? ESOPs are a lottery ticket, which they clearly didn't hit. A lot of times they took a pay cut, or they took a, cash cut and hire ESOPs because they wanted to bet on the startup and sort of do that wealth creation through equity. Those people are now going to be back in the market. And now, a lot of people say, hey, this market is, there's always going to be demand for good talent, because if this startup is not working well, the other startup is going to work well. I completely agree with that. But generally layoffs happen in a winter sort of an environment where everybody is conserving on cash. What that means is these employees will not be employable because of their fat salaries and the ESOPs that they expect from the new startups, right? The new startup is going to say, you are a stellar talent, but I don't have the budget to hire you. So either you have to reduce your price and then go through that psychological challenge of reducing your salary.
Can I give an example of what I have seen? Because I'm not in the VC ecosystem, but what I have seen in the non VC ecosystem. So I have a couple of friends who run tech businesses. These are not like your high flying tech businesses, but they're still solid tech businesses. And they have to hire for their business. They have to hire all these developers and all this stuff. For the last 6 months, for the last year, in fact, actually maybe year and a half, they've been complaining so much about hiring. They've been complaining literally every time I see them. They're like, dude, these guys are asking for 2x 3x of their current salary. I just cannot pay them, and they're leaving, and they're losing all of their talent. And now what they're saying is that, okay, it's started to improve because this VC winter has started. And this is one piece of evidence that I'm also using as the fact that the VC winter has started, is that these people are saying that, okay, it's not as bad as it was 6 months ago, but it's not like perfect yet. But apparently it's going to take like 18 months. Somebody gave me this random date, that's going to take 18 months for the entire hiring ecosystem to go get back to normal.
No
That's a
one knows,
completely
no
random
one,
date.
exactly, no one really knows. Everybody is guessing, so are we. Like, you can't really predict the timeline. You can more or less say this is what's happening at a micro level, but predicting timeline is very very difficult, right?